Welcome back, investors, to Ticker Time News. I'm Adam, and what a crazy, weird, unfortunate, and disappointing day we had in the market today. I must say, I misread the market yesterday. And what happened? Why did the market completely waste away all of the gains from the past 3 sessions, including the new low of the year that was made on May the 2nd, and of course, the big, humongous gains from yesterday afternoon post FOMC? So we're going to try to get into that and understand today's action and what went wrong, what happened, and try to explain it. So remember, though, as we do this, the quick take of today's video is in the beginning of the video. Your questions are answered at the end of that quick take, so we can get that out of the way in case somebody wants that information. There it is. So I'll kick it off while you get your questions ready. Welcome back. Thank you for joining me. The S&P 500, it dropped 3.6% on Thursday in a overly disappointing session, I would say. The Nasdaq fell 5%. The Russell 2000 declined 4%, while the Dow Jones retreated 3.1%. The most startling aspect of today's session was that yesterday's huge post-FOMC rally was wiped out within the first hour of action this morning. Aside from an uptick into the close today, there was little interest in buy the dip and a lot of interest to hedge against further downside. The CBOE Volatility Index, or the VIX, VIX, you can all follow along at home using TradingView. There is a link in the description for a free account. VIX, ticker symbol VIX, and then choose on the right-hand side here, CBOE. This is the one you want. Second one down on the menu. And you can see a spike of 22.74%. Right here on the right side of my screen, this gives you the number where the VIX is currently at, 31.20. And the percentage gain today of 22.74%. That's over here on the far right-hand side of the screen over here. Now, it's at 31.2. And remember what we have concluded here over the past several sessions, over the past couple of years, whenever the volatility index, the VIX, reaches 35 area, it typically does a major reversal. So could we have another day of sharp selling? I mean, tomorrow is Friday, and whenever fear is high in the market, investors or traders more specifically don't tend to like to hold open positions through the weekend. So there is a possibility that tomorrow is another red day. And maybe we even make a new low for the year tomorrow, as it's Friday, and investors or more likely traders want to close their positions before the weekend, because who knows what type of headlines we could get, right? And that would most certainly push the VIX up to 35. And then maybe we get some relief on Monday. It's a possibility, right? We got to make sure we're rational in our decision making. Like I told Patreon members yesterday, or maybe it was the night before, but it was right there before the FOMC meeting. And I said to them, I said, don't react to the initial headline reports. Wait to see how the market reacts during and after the press conference. And that was a smart point to make, because there was a lot of reactions yesterday, and short selling seems to be one of the biggest reasons that we can come up with on what happened today. because selling was broad-based. All 11 S&P 500 sectors closed within or closed lower, with losses ranging between down 1.1% for utilities and down 5.8% for consumer discretionary. Plus, in the Dow Jones, and I'll pull up the stock chart here for the Dow, all 30 stocks in the Dow Jones closed lower. And remember, we talked about this odd happenings here. The Dow didn't make a new low on May the 2nd, which had me wondering, something's not right. Something doesn't seem right. Because the other major indices made a new low on May the 2nd for the year, but the Dow didn't. So now I'm thinking that mystery is being solved right now, and the new low is coming. So, just like on April the 29th, all 30 Dow Jones stocks closed lower. And those are Walmarts, right? Big market cap companies in the Dow Jones. Now, declining stocks that were going down, and this seems to be obvious, but the margin here is huge. But declining stocks today outpaced advancing stocks, or stocks that are rising, by an 8-to-1 margin at the New York Stock Exchange. 8-to-1 margin. So for every one stock that was green, there were 8 stocks that were red. That's saying something. What could a message like that be saying? Add all these things together that I've said so far about the market. What could all of these things be saying? One thing that came to mind when I asked myself that question, it's down days like today that often inspire Warren Buffett to do some buying. That's an interesting thought. Did you do any buying today? There was one that I bought today, and I'll share that with you in a moment because they also had earnings come out after hours. So we'll talk about Opendoor in just a moment. DoorDash also did good. E-commerce, whoa, there's some doom and gloom there. But another story to this market, the behavior of the Treasury market was one source of worry for the stock market, especially growth stocks, because the 10-year yield rose 15 basis points to plant itself firmly above 3%. Let's look at that. The ticker, US10Y, to get to the 10-year yield. Now, the 10-year rising 15 basis points, it closed at 3.07%. It actually hit 3.1% intraday today. That is high and worrisome for growth stocks. Now, the past few sessions, growth stocks have been performing okay in the face of the 10-year rising. But today, that correlation of the 10-year rising and growth stocks falling definitely came into play. And remember, we've looked at this 10-year yield before, and it rising to 3.25 isn't that far out of the picture. We only have to go back to October of 2018 to find it at 3.25%. Remember that. So it's getting awfully close to that peak in 2018. And what did the stock market do in 2018? It fell. Now, another area to look to see growth stocks falling, and I bring this up often, is the Vanguard Mega Cap Growth ETF. The ticker symbol is MGK. Pull that one up. MGK. Write this one down. MGK. It's one that you can use to follow how growth stocks are reacting. And I must say, this little mark that I have here is funny. It fell 5.1% today. Now, the encouraging thing about this, and this is what has me on the fence about tomorrow. It's a Friday. Fridays can be red days, but they can be green days too. And some encouragement about tomorrow being a green day is right here. In the after hours, for the Vanguard Mega Cap Growth ETF, it's up 0.5% in the after hours. If we go look at the 5-minute chart here, you will see at the end of today, let me take volume off the screen so it's a little clearer. At the end of today, you see this curving, and let me get my brush out here. We can see this together. At the end of the day, we have this right here. Right, just like that. That could be a sign about tomorrow, particularly for growth stocks. So what would this be? This is the 5-minute chart. So each candle is 5 minutes. We've got 5, 10, 15, 20, 25, 30 to 40 minutes. So the last hour of the day, we'll put it. The last 45 to 60 minutes of the day. Growth stocks rebounded. People were buying the dip on mega cap growth stocks, like your Google, for example. And as a matter of fact, let's pull up Alphabet. GOOG on the stock chart. And let's see what happened during the last hour of trading. Let me get my little marker out here. And if we go back about an hour here before the close, what do we see? We see a rebound in Alphabet. That could be a sign for tomorrow. Now, I find this interesting. Let's go look at the daily chart here for Alphabet. And yeah, my squiggly line doesn't look like an arrow now. But the point is, I guess the squiggly line there is in the way. But the point is, the candle got to a low here of 23.03. And Alphabet closed at 23.34. So about a 30-point rise, or a $30 rise, however you want to look at it. But it was up 0.25% in the after hours. So that looks good for a possible rebound tomorrow. Or at least if we're sitting on the fence and we're not sure whether this is going to be a red or a green day, these 2 points of data right here kind of push us over to the green side. But don't forget about the VIX. VIX. And I want to show one more thing here on the VIX. One more thing. Sometimes, and let's go back not to the red circle where we're in right now. This is still the daily chart. Sometimes you'll get above 35. Like, look at the first or the red circle to the left, all the way to the left. Sometimes you'll get above that 35, and then a few days you won't, and then in a couple sessions, you won't get back to 35. You'll have another day where volatility rises. It doesn't get to 35, but it does get back into that red circle, and then it drops, which means stocks rise. And again, you can see that happen over here. The first candle in the middle red circle that gets above 35 is this really tall candle. It gets all the way up to a 37 and above. And then we get several candles in the red circle after that. We get a green candle, which means markets were going down. Red candles mean markets were going up. And we may not get all the way back to a 35. All the way to the right side of that middle circle, middle red circle, you can see that we don't quite get back to a 35 and the market rallies. So if we look at our current circle, the one to the right now, it got above 35 on May the 2nd. And then we had a nice rebound on May the 2nd, a green day on May the 3rd, and a green day on May the 4th. May the 5th, it got back in there, but it's not quite to 35. So maybe it's not going to 35. Maybe it's going to turn around and we're going to drop right out of this red circle tomorrow. That's a possibility, and historically, it is a possibility when we look at these other circles. So a couple things are pushing me over to the side that tomorrow could potentially be green. But then again, inflation worries were compounded today by a larger than expected 11.6% jump in the preliminary unit labor cost for the first quarter. The expectation was only 7.3%. So that's rising very quickly. This transpired during a slower growth quarter in which preliminary non-farm productivity fell 7.5%. There remained a disconnect between the Fed funds futures market and what Fed Chair Powell said yesterday about rate expectations. The futures market, according to the CME FedWatch tool, is assigning I almost got the numbers flipped. An 87.1% probability for a 75 basis point rate hike in June, despite what Fed Chair Powell said yesterday, that it's not being actively discussed. So what investors are feeling and what the Fed said yesterday are not matching up. They're bumping heads. So is the Fed going to do a rug pull? Say that on, and let me look at the date here. The Fed says that on the next meeting, there's going to be a 50 basis point rate hike. So if the Fed said that yesterday, then why are investors feeling like there's going to be an 87% probability of a 75 basis point rate hike? Why is there a conflict there? Shouldn't investors feel like, well, the Fed told us what's going to happen. Why shouldn't we believe them? because the Fed's lost all credibility. That's why. Jerome Powell even said yesterday during the press conference that there's no credibility issue with the Fed, but there is, and there has been for a while, and it's building, and it's growing. And that's why there is such a difference between what investors are feeling and what the Fed is saying. Because investors have lost faith in the Fed because the Fed allowed inflation to get out of control. How long did we hear last year about transitory? That word transitory. Inflation is transitory. We heard that for a year. I'm sorry, but transitory doesn't typically last a year unless you're talking about some mysterious thing happening in the universe on a much larger time scale. Am I right? All right, let's look at the 2-year yield and what it did today. And remember, the 2-year yield is more sensitive to changes in the Fed funds rate. US 0.2, you have to put that 0 in there. Why? That gives you the 2-year. It jumped 11 basis points today to 2.72% after dropping 15 basis points yesterday. Of course, the day before, it also popped. So we've got some imbalance here and some uncertainty. I think it's time that I move that line. So there's an imbalance here. One day we gain, the next day we taketh away. Then we gain again. Oil also rose yesterday, but today, much like on Tuesday, it was basically flat. It increased 0.2% to $108 a barrel. We got to get this oil under $100 a barrel, but in our current situation, that's just not going to happen. It's just not a high probability of that. Now, there was a separate source of worry in the market today, and that was disappointing earnings and or guidance from e-commerce companies. Amazon warned us. When Amazon reported their earnings, they warned us. Shopify, SHOP is the ticker. Shopify was down 14.9% to close today. It missed. Look at this. It reported a 20% EPS. The expectation was 62% EPS. 67.68% miss. Revenue, kind of flat. They missed by 3.2% or $39.8 million. They still brought in $1.2 billion. Another one, eBay. Ticker symbol is the company name, EBAY. eBay was down 11.7% today. Now, remember, I said earnings and or guidance. eBay is not guiding for a very bright future. They did beat EPS by 2 pennies. They brought in $1.05 per share of EPS, and revenue is basically flat. They beat by 22 million. They brought in $2.48 billion. What about Etsy? Ticker symbol is the company's name, ETSY. Etsy fell 16.8% today. It is flat in the after hours. They did not guide for a very bright future. They beat EPS by 3 pennies. They brought in EPS of 60 cents per share. Expectation was 57 cents per share. Revenue was basically flat. They beat by 2.9 million. They brought in 579.2 million for the quarter. And lastly, and this was the biggest, you could say, disappointment or the biggest drop, Wayfair. Ticker symbol is the single letter W. Wayfair dropped 25.7%. 25.7%. Look at their earnings. They missed EPS by 25% or 40 cents per share. They brought in, well, they didn't, because it was a loss of nearly $2, $1.96 per share loss. Now, they were expecting a $1.56 a share loss. Revenue also missed by $4.6 million, but that's practically flat. They brought in $2.99 billion. And remember, they brought in $2.99 billion, but did not make a profit on that revenue. So they dropped 25.7%. E-commerce is not looking good. It is not a spot to invest in at the moment. However, and I talked about this when I talked about Amazon in a more deep look at it. I guess it was 2 live streams ago. When we looked at Amazon, we were kind of comparing Amazon just roughly to 2019 and where it is currently after where it's been. See, 2019, the high that the stock reached was about 21.89, 21.90, around that. And then the pandemic shot Amazon up big time because everybody was locked at home and could only do shopping online. But now that people are out and about again, we cannot expect online shopping to remain anywhere near the same. Now, yes, more people will rely on online shopping because, well, we found out how convenient that was and that it actually worked for the most part. But we cannot expect growth that big. I would say Amazon somewhere in this green box right here, which is 2,400 up to 2,450, I thought might be an okay place just looking at technicals for Amazon. But Amazon also fell 7.5% today. It is up 0.25% in after hours. So maybe Amazon's heading back down to where it was in 2019. It's a possibility, especially with all these disappointing either earnings or guidance from these e-commerce companies. Now, to switch direction just a little bit, head to the travel industry, the hospitality. Booking Holdings, ticker symbol is BKNG. They reported. They were up 3.3% today. In a day where everything was dragged down, they were up 3.3%. How could that be, right? Well, Booking was one of the few positives, right? For every 1 green on the New York Stock Exchange, there were 8 red. So here's one of the greens, one of the positives for today. And it was an observation that gross travel bookings for the summer are currently running about 15% higher, not than last year, not than 2020, but 15% higher than in 2019. That is a much better year to compare things to because that's pre-pandemic. 15% higher than 2019. If we go look at where booking was 2019, we go back to this area here. They're almost to it. It's a very expensive stock. They need to do a stock split like everyone else. But if we go back to pre-pandemic, we can really see it in January of 2020. That was kind of like their high. And they also September of 2019. So if we look at that span, the stock was right around 2,075. And we closed today at 2,171. So nearly $100 above where they were a share in 2019. So that sounds like a really fair place to be. Especially with gross travel bookings for this summer running 15% better than 2019. Booking Holdings did also beat their top and bottom line estimates too, and we can see that right here. They reported, and this is huge, I'm surprised the stock wasn't up more. If the market wasn't being dragged down so hard today, bookings would have soared a lot higher than 3.3%. They brought in EPS of $3.90 a share. Expectations were only 85 cents a share. That's a 358% surprise to the upside. That's incredible. Revenue was a beat by $163.5 million, or 6.4% surprise to the upside on revenue. $2.69 billion is what they brought in. That's really good. And that is also really profitable on the earnings front. So I'm watching you, bookings. You might have something here. Now, on the economic front today, we got the weekly initial claims report, and it showed that jobless claims for the week ending April 30th rising by 19,000 to an even 200,000. Continuing claims for the week ending April 23rd decreasing by 19,000 to 1.38 million. Get this. This was the lowest since January 17th of 1970. That's a hot labor market. The takeaway here is that initial claims are still running near historically low levels that point to a very tight labor market and the likely persistence of wage-based inflation pressures. Now, the Fed's not going to be able to fight those inflationary pressures unless they force a recession. And they force companies to slow down, and they force consumers to stop consuming, which then forces businesses to lay off people. That's the only way the Fed can fight inflationary pressures in the labor market. And that's what the Fed will do if they end up raising rates beyond what they're needed to do. And at this point, the Fed has no choice. You've heard me say it many times. The Fed has two mandates: unemployment and inflation. They're fine on unemployment. They're focusing on inflation. And their tool is to suck money out of the market and hike rates. That's all the Fed can do. And that's what the Fed is doing. And that's going to hurt the average American. Also, non-farm business sector labor productivity, that decreased 7.5% in the first quarter. Unit labor costs soared 11.6%. The first quarter decline in productivity is the largest, and you're not going to believe this. This is going to blow your mind. It's the largest since the third quarter of 1947. 1947. Are you kidding me? The Fed is just going to wreck this. The takeaway here is that it's a reflection of weak economic activity and rising labor costs that threaten corporate profit margins in the quarters to come. Key words here: threaten corporate profit margins for the quarters to come. If these corporations aren't bringing in the profits, where's their stock going? It's not going up, it's going down. That contributed to today's declines as well. Okay, here's where we stand year to date. The Dow Jones is down 9.2% year to date. The S&P 500 down 13% year to date. Russell 2000 down 16.7% year to date. And the Nasdaq is back in bearish territory, down 21.3% year to date. Okay, two companies I just want to mention right quick. Earnings after the closing bell today. Open Door Technologies, ticker symbol OPEN, Open. Open Door, their shares popped 13.7%. They gapped up in the after hours, and they were down 10.8% today during regular session, and they popped in the after hours. Now, it doesn't seem like much, this is the daily. Actually, let me go to the hourly. You can see it a little bit better. So this is each candle represents 1 hour. So it's up here. This is where it will open tomorrow at. The candle, they had a nice gap up. Down here, up 13.7%. This is where the candle will open up tomorrow, up here. Nice rebound, nice jump. And if we kind of scroll out here, you can see that the company has, again, this is the hourly chart. So there's going to be a lot more candles on here. You can see the company has been in decline for several quarters. And it finally had a good one. Now, Open Door, the reason their shares gapped up in the after hours is that after the real estate platform's Q1 earnings reflected a substantial boost to profitability. And it's expecting Q2 adjusted EBITDA of $170 million to 190 million. And this is going to blow your mind. That's up 604% year over year. At the midpoint of that 170 to 190 million dollar range, a 604% year over year gain. That is why the stock gapped up. That is incredible. Go back to the daily here. Absolutely incredible. Now, by comparison, Q1 adjusted EBITDA of 176 million soared from a loss of $2 million in the year ago period. Again, incredible gains for Open Door. All right, let's look at a company that I have to admit I've been using their service a little too much. DoorDash. DASH. Yep, been using them a little too much. And I guess it helped because DoorDash jumped after reporting Q1 revenue ahead of expectations. They were up 8%. And you can see this stock has been falling as well, just like all growth stocks, right? So a nice quarter for them. Orders rose 23% during the quarter to 404 million. And the marketplace gross order value was 25% higher at $12.35 billion. I was a part of it. Now, adjusted EBITDA in Q4 was $54 million versus $43 million a year ago. Yeah, they're doing good. Obviously, as people have gotten a little too convenient with ordering from DoorDash, it is definitely not the cheapest way to go, but it sure can be convenient. All right, let's see here. Wow, what a bloodbath. Yes, it was. Yes, it was. I figured it was going to drop at the bell. I thought it would reverse at 420 and got stopped out. Yeah. Unfortunately, that's what happened. All right, ladies and gentlemen, I appreciate your attention in watching today. A 41-minute quick take. I guess I should take the word quick out of it because that's not a quick take. But there was a lot to digest and go through today to try to figure out why today was such a disaster in the market. I want to talk just briefly here about the technicals for the S&P 500. Now, you can see here, well, hopefully you can. It is, I admit, it is difficult. But the candle today, big red candle, we closed inside our yellow box here. Okay. The wick, the bottom wick of the candle did extend past this box, but it did not make a new low for the year. That still stands from May the 2nd. Could we potentially be heading there? Well, my thesis for the next 3 to 6 months is not looking good. As I tighten up this chart here, you're going to see a new yellow box I added today. Over the next 3 to 6 months, this is where I believe the S&P 500 is headed. This is very easy to calculate. All I did was go from the high that was set on January the 4th of 2022. The high on January 4th, 2022, and then I dropped down 20%. Right there at 20%. And you can see this purple line that is going diagonally down matches right up in that corner. That's where I believe the S&P 500 is going over the next 3 to 6 months. Because the Fed is going to fight inflation hard. And that's why there's this differing between what investors think the probability is for the Fed funds rate versus what the Fed actually says. They're on two complete different sides. One is saying, no, we'll be 50%, half a percent next meeting. and the other is saying, nope, I'm calling your bluff, it's going to be 0.75%. Investors have lost faith in the Fed. That's what this all boils down to. Short covering from yesterday led to yesterday's rally. I must admit, I did not follow my own advice that I gave to everyone on Patreon. And if you want to join in, just click the first link in the description. We'll be happy to have you. When I said, don't let the headlines dictate what your next step is. Watch how the market reacts during and after the press conference. So, here we are today, down over 3.5% on the S&P 500, and this forecast here in front of you for the next 3 to 6 months, we're heading to a low of 20% from the high made on January the 4th. Okay, let's see here. Do you what the CPI expectations are and where? Okay. So let's see here. Yep, I gotcha. Okay, so a place to follow, here it is. I'm going to put the link in the description. This is where you follow the CPI, Consumer Price Index. And here's the link in the live chat. This is where you follow everything CPI related. This box right here, where it says, you get down underneath the header here, news releases. This is where you watch for all updates on CPI. Now, CPI forecasts, I'm not sure if it's a public or paywall. Let me see here if it's public or paywall. Still looking to see if it's behind a paywall or not. I'll have to get back to you on that one. I am not finding it yet. I'm looking. All I've got right now is what's on the screen here and the link that I sent you. I'll have to dig into it a little bit deeper to find an exact answer. And I'll post it over, I'll post it over in Patreon when I find it, just to give you guys an update on that. I can also post it in the forum on our YouTube channel. Everywhere I look, I am not finding April yet. I'm finding the 8.5% from March, which was the actual. It looks like it might be all behind paywalls. So let me go over here and look. All right, I'll have to get back on that one. I cannot find, oh, maybe, hold on. All right, hold on one second. I think I found something here. April. Okay. CPI is next Wednesday, May the 11th. That's when the report comes out. Right now, I see no expectation on a number. And then the PPI, which is the producer price index, that's also related to CPI. One's consumer, and then one is the producer, which is the business. That comes out Thursday, May the 12th. So CPI, May the 11th, Wednesday, May the 11th, and PPI, Thursday, May the 12th. And right now, I have no expectation as for what a number could be. All I have listed here, and this is behind a paywall, otherwise I'd show it, just to be fair. It only has what occurred last month. It does not have the expectation for this month. So I'll dig a little deeper on that one and post it over in Patreon and in the community forum on the YouTube channel. Otherwise, no way it goes down this month. No, I don't think it's going to go down this month. Not at all. So if we got 8.5% in March, and that's right here on the screen, it rose 8.5%, and that's an annualized percentage rate. It's definitely, I believe, going to go higher than 8.5%. I don't know 9%, but oh, hold on. There's something else. Oh, where is it? there is a oh, hold on. Oh, this is cool. Hold on. Let me pull this up on the screen. This is a place that I just recently learned about. I'll put the link in the live chat here. This is alternative data, okay, on consumer price. Let's see here. Here's the link in the live chat. So this is in direct competition with the CPI, right? So CPI on March was 8.5%. And then over here, this is alternative inflation charts. What this is doing is over the years, like from 1970, 1980, and so forth, how the government calculates the CPI has changed. And over the years, it should change, but the government can cherry pick the changes that it makes so things look better than they are, right? Well, what this is showing you, this it's shadowstats.com, and I just learned about this, and it's quite fascinating. It shows you what the CPI would be without the changes the government made. I meant to share this with you guys earlier, but this is really fascinating. So this bottom chart here, it says consumer inflation official versus shadow stats. And this is a 1980 based formula that they're using. So if we look, 8.5%, that's the red line here all the way to the right that you see it spiking up. That's CPI, how the government calculates it today. But if the government calculated CPI based on their formula from the year 1980, and I understand things change, the economy evolves, so should our way of calculating things, our formulas. However, the government shouldn't cherry pick to make it look better. But anyways, based off of how the government calculated in the year 1980, real inflation would be somewhere around 16, 17%. It's just crazy. I meant to share this with you guys when I first found it a week or two ago. Now there is a paywall for some of this information, but the gist of it, the explanation for what they're doing, the charts, they're open for everyone to see here. And it's fascinating. So I put the link in the live chat for this one. Watch this one too. It's fascinating, I must say. And then of course CPI. And then if I find an expectation for CPI for next week, also the PPI, I will definitely share that with you guys. Let's see, what was this one? Yeah, so if I find an expectation, I'll share it. Your 9.1 to 9.2, is that your expectation, or did you find that as an expectation somewhere? Let's see. I'm still not finding an expectation. Yeah, I don't know. Quite frankly, your 9.1 to 9.2 could be spot on. It would not surprise. I would not be surprised. And of course, a move like that is definitely going to freak out the market and cause selling pressure. That's a definite. It's also going to would cause the Fed to probably match up with what investors are saying with a 75 basis point rate hike with the 87% probability. All right. Well, we'll wrap up this session today. I greatly appreciate everyone watching. I appreciate you very much. And again, when I find the expectations, I'll share it. Patreon got everyone on Patreon, and I'll share it on the YouTube community page as well. And when I do find it, I will make sure to share it during the live stream as well with you guys. But yeah, definitely check out this shadow government statistics. Not saying that it's accurate, but it does give you another look at the consumer price index and what's happening with it. So you are welcome. I greatly appreciate it. Thank you very much. Make sure to smash that like button. Share this video, because that is a big help. We don't have a marketing budget, so sharing this video definitely gives a thumbs up to what we're covering here. And make sure to click the first link in the description if you haven't already. Join us over there. Definitely share a ton of information that is helpful in understanding this crazy market and beating this crazy market. All right, ladies and gentlemen, thank you for watching, and we'll wrap it up for today. And I'll see you tomorrow after the markets have closed. Take care. Good night.